Hi, this is Mike Yan. I'm a client portfolio manager here at Westwood. Today, it is my pleasure to introduce our market outlook call. We have Leah Bennett, President of Westwood Wealth Management, and Adrian Helfert, Chief Investment Officer for alternative and multi-asset portfolios. They are going to discuss what we see in the capital markets and some of the key trends we are watching. They'll discuss the role of inflation, expectations on upcoming Fed actions, and their implications. Leah, Adrian, good afternoon.
Thanks so much, Mike.
Thanks, Mike.
So Adrian, I've been thinking quite a bit about last year was such a great year for the equity markets and actually a decent year for fixed income. But if you reflect back on the last 3 years, everybody's been trying to call the recession. When are we going to go into recession? The yield curve's been inverted. There's definitely been some signs. So what do you think has changed significantly so that now we're in a situation where the markets have done well and people are talking about maybe the economy reaccelerating?
It's like the economists have given up the ghost of the possibility of a recession. Great question. And that really it's almost the question of what's changed so much. We had this difficult year in 2022 where the equity market was down nearly 20%. Bonds were down significantly as well. And economists were en masse. There was about a 65% chance consensus rate of we're going to see a recession in the next year. And a defined recession, so difficulty in labor markets, lower consumer spending, as well as negative real GDP growth. What's changed is certainly that it seems like we've had pent-up consumer savings that has kept a consumer still spending. Recall, consumption is 75% of our economic growth. So the consumer didn't stop spending at the same time that we saw technological innovation that helped margins remain sustained for companies, so companies could continue to make decent earnings with a good spending consumer at the same time that wages remained elevated. Of course, wages are a big deal as well. Unemployment has remained low. If you want a job, you can find a job across the street. Generally, unemployment is low on historical standards, which means consumer sentiment remains high, which means that wages are doing okay. And really, they've helped offset a lot of the inflation impulse that we've seen in the economy. That's helped us get through. But just looking at where we've been, you mentioned the interest rate curve. Oftentimes, one of the biggest leading indicators of the potential of a recession is the U.S. government interest rate curve, or the maturity differences between say a 10-year U.S. Treasury and a 2-year U.S. Treasury. It's inverted right now, has been for the longest time, I believe, in history, meaning you get less yield for investing for 10 years than for 2 years in a U.S. government bond. And every time that's happened in the last 7 recessions, well, every time that's happened the last 7 times, we've seen a forthcoming recession. This time, we have not. So if you look at probabilities just derived from that, we came from a place where we're still at the highest probability of a recession predicted by the interest rate curve since 1982. That's over 4 past recessions, yet we haven't seen it. And finally, it seems like economists are giving up the ghost. They're saying that we're going to see forward growth. Maybe we came through this because we saw better consumer spending, lower consumer leverage as a starting point, and technological innovation help our way through.
So given your comments, if you think about the yield curve being so inverted, we have lots of clients who have gone through liquidation events or have needed income, and it's been easier to get income. They've either been rolling treasuries or you can buy fixed income, and it can be additive to the portfolio, right? It's got a nice yield. You're not taking a lot of risk. But how do you think about if the economy does start slowing and the Fed does start cutting interest rates? How do you think about these people? How should they be thinking about replacing their income?
Well, cash hasn't been the place to really replace your income over a long haul. It's a short-term investment that only shields your volatility during short periods of that. And you're right, here we are at this point that we've seen us get through a period of higher inflation and potential for a recession. And suddenly the Fed is at a point where interest rates are elevated relative to where they consider to be the neutral rate or the longer term interest rate. And they've communicated pretty well. If you saw Chairman Powell on 60 Minutes saying the next act is likely to be an interest rate cut. they're going to start cutting interest rates, not because we experience an economic downturn, but because we're moving back to a balanced interest rate environment where they see interest rates lower. And that's positive, that's stimulative for the economy. Because that's stimulative for the economy, it's less likely that holding on to cash at a point where you maybe still get 4%, 4.5% in your checking account effectively, but you're likely to get better than that finding opportunities in the markets where we see a Federal Reserve that is going to move down to a more neutral rate. So last year was a good indication of that. Over the long term, holding onto your cash has been one of the lowest, if not the lowest returning asset class. And last year was no different. It was the second worst performing asset class, just above commodities, which generally had a downturn last year. That was in relevance to, it was 5% that you were getting in your checking or your CD effectively. But look what risk assets did. Look what high yield did, returning 13% in other areas. So what we often talk to investors about on my side is find opportunities that go in line with, we're seeing a increased potential. We're seeing the potential of an accommodative Federal Reserve that may stimulate the economy, or at least have the ability to stimulate the economy if needed, and find alternative income that is outside of your cash that is going to have less and less yield as the Fed drops interest rates.
And if you think about, depending on what the risk profile of somebody is, when you get in environments where interest rates are falling, usually it rewards more risky assets. So if you think you really start moving up that capital structure, so cash usually pays the least. You've got fixed income that benefits from declining interest rates, and then equities tend to outperform. So I think those are all kind of a shift in thinking from the last couple of years, but something that we should definitely be talking about. I do have a question for you on, everybody kind of talks about where we are in the cycle, the economic cycle. Do you think the market still, the economy still operates in cycles? And if so, where are we?
I'm a long-term cycle believer. I think that both the market and the economy operate in distinct cycles that we can try and divine. And if you've heard me speak on this call before, I have a framework for that is, it kind of starts with consumer sentiment. If you feel good, you can walk across the street and get a job. Your pay is going to come in. Your spouse is going to remain employed. Then you go out and you consumer spend, discretionary style. You buy the trampoline for the backyard for the kids. Then that leads to companies that are increasing their capital expenditure. They make more of those machines to make the trampolines. And then they hire people to man the machines making the trampolines. So that's more demand for jobs at the same supply, which leads to wages increasing because demand over supply. Wages are increasing, you feel good, you can walk across the street and get a job, unemployment remains low. That's my vicious, sometimes a virtuous or vicious cycle. Right now, it's still been virtuous, and that's helped us navigate. So I do believe we operate in cycles. I have been looking at this we bottomed on consumer sentiment in 2022. We saw it rising over 2023. We didn't see the signals that was telling us that we were going to enter a vicious cycle in 2023. Thus, we remained a little bit more positive, and we still don't see that. We see more virtuous effects. Matter of fact, now in this earnings season, we're starting to see companies saying that capital expenditure, which has been, I'd say, lackluster, not bad, but companies haven't been deploying capital for new forward economic spending. And now we're seeing in this earnings cycle that is happening, not just in the technology space, but in other areas as well. In industrials, they are spending because they see the forward prospect of demand. That's a continuation of consumer sentiment remains strong, a consumer keeps spending, companies continue to deploy forward capital expenditure to then increase their own profits and keep people employed. That cycle continues. And till we see something change on that, then we remain reasonably positive for the forward environment.
I also think it's interesting if you tie it in and really think about investing because of the Fed and the tools that we have available. The volatility in the economic cycles has been lessened. We seem to have shallower lows. The sell-offs are much more abbreviated than what they used to be. If you think about 2022, and it was a very difficult year for the markets, but you had interest rates go up significantly. And I think if that were to happen a couple decades ago, it might have taken a couple years for that to play out. It happened in a much more condensed period.
Agreed. And it's, one thing I like to think about now is, because we have raised interest rates so dramatically, it's not about necessarily when we're going to cut. And I get these questions a lot around, well, are they going to cut rates in June or maybe September? It's somewhat important, but it's not the main point. The main point is the Fed is telling us that, number one, the neutral rate, the balance of their dual mandate of labor and inflation, is considerably lower than where we are today. Today, we're at 5.25% to 5.5% band on the interest rates. 2.5% is the neutral rate, and they're telling us that's where we're headed. The second thing is, it's not will they or when they, it is can they. They can, therefore, exactly as you're mentioning, they could potentially suppress volatility if we see it enter the market. So if the S&P 500 drops 20% and your 401k is dramatically down and your house prices are dramatically down for some reason, the Fed now has the capability of incentivizing markets, of reducing overall volatility to your 401k plan, versus a place where we were in a near zero interest rate monetary policy cycle where the tools just weren't there.
If we're talking about the Fed, we should talk about inflation. And we've seen lots of data and lots of mixed data in the last few months. So we definitely had the CPI come in a bit weaker than expected in November, which led to an acceleration in appreciation in the broader market, which was great to see. And then we saw January come in a bit stronger, a bit hotter than people expected. So I'm kind of curious, what do you think? Is inflation trending down, and does it matter at this point?
Well, good timing for that question, because tomorrow we get a big inflation print. So whatever I say today could be wrong tomorrow. And it's the biggest really inflation print for what the Fed thinks about inflation. It's called core PCE, or price for the consumer, effectively, or price for consumer expenditures. That's the one that they're using for the less volatile, excluding food and energy, to say how much is the consumer really taxed on inflation. We'll see more measures of that, but it is trending down. And generally, this has been less of an inflation problem overall than a goods inflation problem. Goods inflation has risen dramatically. It got in 2022 to up the core PCE measure up around 6%, where the measure for the Fed is we need to be around 2% long term for stability, is the number that they use. We're getting close to that. The last print that we had was 2.9%. The expectation coming tomorrow is 2.8%. And it's been trending down. And that trending down is one of the more important pieces of the puzzle. The Fed is less insured about the exact level where we are now to ensure that they've broken the back of goods inflation and that it's trending down. But the reason I differentiate between goods inflation and a true inflation problem is wage inflation has remained elevated. It's almost back to that first question of what changed? Why were we able to avoid this predicted recession? And unemployment remained low, sentiment remained reasonably strong. Wages were a key part of that. And as long as wages were keeping up with, if not even outstripping, goods inflation, then you might not have liked the fact that milk went up $1 a gallon, but your increase in wages could help you afford that.
Yeah, and yeah, you've kind of alluded to this battle that you have going on. I mean, if you look at all the labor unions that put through these big increases in with wages in the fall and late summer, battling with these massive adoptions of new technology that are deflationary, it is an interesting push and pull that you have between the two. And I do think inflation is going to continue to cause a lot of volatility.
Agreed.
At least in the markets. And it'll be interesting. So the other thing that usually causes a lot of volatility is obviously earnings, and we're at the tail end of earnings season. So kind of curious what your thoughts are on what were companies telling us.
This was an interesting earnings season for us, for sure. We came into the earnings season, and us as fundamental investors, we're always looking to not just how much companies can maintain their margins and what new revenue pathways are, but what they're telling us about the forward environment and how things are doing. At the beginning of the earnings season, there was an expectation or a consensus from analysts that we would see about 3% earnings growth. Here we are at the tail end of the earnings season, and we've seen on average 7% earnings growth. So it's gone well. We've seen good earnings in this season for sure. Now, much of that has been in mega cap tech still, where these still have strong cash flow production and good areas. The overall overarching theme, though, I would say, is that it's nice to see companies are able to maintain margins in a environment of higher inflation. So generally, companies have been able to maintain their corporate margins, their earnings margins, in an area where we've had heightened inflation. We actually look through some of the reports and we aggregate some of the ideas that we see, the themes that are coming out. One of those themes is, no surprise, artificial intelligence. And this is the most mentions we have seen over an earnings season so far of new artificial intelligence impacting the business, new revenue potentials, et cetera. It's not just in tech. This is in the energy sector, in the healthcare sector, in the consumer discretionary sector, where companies are mentioning ways to find either new ways to enhance the customer experience, or new revenue pathways, or new product offerings, or just simply new efficiencies, things they can use to do more with less. And so we saw more of that. That was one thing. Supply chain is something that we had been discussing over the last several years, really kicked off when we had the geopolitical risk with Russia and Ukraine, where we had supply chain breaks that led to higher prices. And now we're seeing companies, number one, saying that supply chain problems are easing a little more. So you see better pricing for supply chain goods, number one. And number two, you see a lot of companies that are saying they're actually putting in place alternative ways to deal with their supply chain. That's a good thing. That should reduce forward volatility from things like geopolitical risk that we might see in the environment. That was a very positive impact that we saw out of this. Otherwise, I'd say it's back to the maintenance of margins and labor. And companies were telling us actively that the balance of labor has shifted to the better a little more. Generally, the tech companies are saying that they were able to cut a little bit on the labor side that helped them maintain margins. And for other companies, we're seeing that there's still, especially in the industrial space, it's reduced some of the pressure, but there is still a little bit of a skill gap. And we're looking towards that to ensure that these companies can maintain their margins.
I think it's going to be interesting because I definitely a big believer of the AI theme, for sure. It is going to be interesting as we see the adoption of this technology and how it impacts operating margins and operating earnings of companies that are more mundane, that can either get better efficiency, or that they're allowed through the technology to really transform their business. And even if you look at the last 12 months ended, I think January 31st, if you look at the S&P 500, it was up like 19.5%. And then if you look at the unweighted S&P, it was up 3 or 4%, right? You still have this huge divergence, and there's still so much focus on NVIDIA and the Magnificent Seven. So it will be interesting to see the opportunity, I think, for the broader market to start outperforming, which it's been a while. It's been over a year since we've seen that.
I agree. And the examples that I go through and look at they're really interesting. I went through each of these companies and was looking for examples of what exactly are they saying about AI? How are they going to use it in their business? Companies like Bank of New York Mellon that mentioned AI and its utility for their analyst pool, that's using it within their analyst pool. They had this funny comment around, well, their analysts don't have to get up at 4 o'clock in the morning anymore to write an analyst report. Maybe now they use AI to write the first few paragraphs and they get up at 6 o'clock in the morning. So it's kind of funny, the efficiencies that they mention. They're going to find ways, I have no doubt, of using these utilities, not just for, that would be a finance example and looking for new ideas, but say in the pharmaceutical sector, where you can go through protein folding techniques at a much faster rate without having to get your mortar and pestle out and find a new drug. You can use data to help you identify new pathways. The thing that you mentioned that's interesting and important of this is where we've seen the beachfront on that is these large companies like NVIDIA that have done so well because they're going to sell more of these assembled chips to facilitate this utility in companies that are finding efficiencies and finding new revenue pathways. That's the forefront. They're not going to be selling chips unless companies will be using them to find opportunities. That pharmaceutical will be finding new drugs. If that part is just going to take time to make its way into the earnings cycle for the other beneficiaries, that will be the broadening that we are looking forward to seeing, that will lead to the non-magnificent seven, the so-called mega caps that are out there right now, benefiting from this. And generally, this should be small and mid-cap stocks that are usually the lifeblood of the U.S. economy. This is the majority of U.S. employment as well, and the majority of U.S. growth. This is innovation and capability. It just takes a little bit more time than the very narrow time we've seen since this has become a dominant thematic in the markets.
I think it's, even if I think back in our business, it's interesting when ChatGPT came out, I guess it was last January, February, more on a broader basis. It's obviously been around for a while, but on a more broadly adopted basis, like people were using it for a job, to write job descriptions or to write contracts, some really basic things. And now it's much more embedded in people's businesses. And even with us, we're using it for research. I mean, there's different ways that we've been able, Westwood has been able to adapt AI. So I think everybody's exploring that. And it's going to be interesting to see how it plays out over the next couple of years.
I agree wholeheartedly.
So if we're thinking, so it's the end of February, I'm kind of curious what your thoughts are as we look throughout the rest of the year and what the economy overall is telling you.
That's a key question for us, of looking at the kind of watch points that we have right now to see, are there continued hurdles for us to cross that gap of the concern around a drop in the economy to experience the growth that we're seeing a little bit of now. Well, we need to see, I think interest rates at least stable, and stable interest rates and continually falling inflation will help that narrative. If we see a reversal in goods inflation, that will be a difficult paradigm for the U.S. markets. We'll watch labor and see how labor's unemployment metrics are doing, and we continually watch various unemployment metrics. If we see unemployment rise a little bit more dramatically, say 0.5%, that would lead to a considerable downturn. That would lead to that. When I talk about the virtuous cycle, that would potentially have a knock-on to a vicious cycle of consumer sentiment would drop. You start purchasing less of those trampolines for the backyard because you're worried about your job. That is something that we'll remain watchful for. We haven't seen much feed through to the housing market, especially the residential housing market, on higher mortgage rates, and partly because the people that didn't need to move, they didn't move. And we saw supply that remained really low, housing supply remained really low in the housing market. So it was hard to find a house, mainly because people that didn't need to move, they weren't moving. If we see elevated unemployment at the same time that we see heightened mobility, people that are required to move or required to exit their house and go to where there might be a job, et cetera, then we could see an impact on housing be a downside. That's not what we expect right now. Actually, we see a little bit more of a sanguine environment there, but that's something to remain watchful for, because that's part of the wealth effect. You feel good when your 401k plan is doing well, and when your house price, which is oftentimes for those that own housing, it's almost part of their retirement plan, is doing well. So should we see the confluence of events that leads to difficulties there, that could be a downturn. But otherwise, I'd say it's still a reasonably positive environment. We saw this extraordinary environment last year of, as you were mentioning, these top 7 stocks that did so well, at the same time that 493 stocks in the S&P 500 were considerably lagging what those 7 stocks were doing. We're looking for a broadening. We're looking for companies that are going to take advantage of the innovation and the signals that we're getting there, and that will happen, we believe.
Yeah, and I also think if we eventually get into an environment where rates are falling, which could eventually happen, it's a question of timing. Then I do think anything that needs financing, so small caps, anything that's more capital intensive, should also outperform. And so I think you agree. I think there's a lot more interesting investment opportunities even than there were last year. So you might just see the return of the market be a little bit different, and active management really play an important role.
100% agreed there.
Thank you so much, Adrian. And we appreciate all you guys dialing in. We are more positive about the markets. If you have not spoken to your advisor, we have an updated capital markets outlook, and we thank you for your time.
Thank you, Leah.
Thank you.